Today, we're going to break down one of the strangest days I've seen in the market in a long, long time. A day where just awful economic news, I mean really bad stuff, somehow sent the market soaring to a brand new record high. How on earth does that even happen? Well, let's get into it and figure it out.
So let's set the scene. The date you need to circle on your calendar is Wednesday, October 1st, 2025. This is the day when everything we're about to talk about went down.
And what a day it was. I mean, it started with a total gut punch. The morning bells rang, and we learned the U.S. government was officially shutting down. Plus, a jobs report came out showing a shocking number of job losses. So naturally, the market opened way down. But then, something shifted. Right around mid-morning, the market did a complete 180. The whole story just flipped on its head. And by the end of the day, the S&P 500 didn't just recover, it smashed right through 6,700 for the very first time, closing at a new all-time high. Just incredible.
Which, of course, brings us to the big paradox. This is the puzzle we have to solve today. How did some of the absolute worst headlines you can imagine lead to one of the best days for stocks we've seen all year?
Well, the answer lies in one of Wall Street's oldest and weirdest rules. Sometimes bad news is actually good news.
You really have to see it as two completely different realities playing out at the same time. On one side, you have the actual economy. It was flashing all kinds of warning signs. A government shutdown, which is never good for confidence, and a private sector jobs report that showed a loss of 32,000 jobs. But the market saw something completely different. It looked at all that bad news and basically said, great, this means the Federal Reserve has no choice but to cut interest rates. And you know, for Wall Street, especially for those high-flying growth and tech stocks, lower interest rates are like rocket fuel.
And I want to be clear, the market wasn't just hoping for a rate cut. It was convinced. I mean, totally certain. According to the CME's Fed Watch tool, traders are pricing in a 99% chance of a rate cut at the Fed's very next meeting. 99%. The market had already decided it was a done deal.
But here's the thing. This party wasn't for everyone. When you look under the hood, the rally was actually really narrow. Yeah, healthcare stocks absolutely soared, up over 3%, and tech did well. But look at financials. They were down 1.5%. The gains in just a few key spots were so massive that they dragged the entire index up to a record, even while other parts of the market were actually down because of those same recession fears.
And you can really see that when we look at 5 of the day's big movers. You had Eli Lilly flying over 8% higher, mostly on hopes for a positive deal on drug pricing. The AI theme was on fire, with Micron and Intel both jumping on huge industry news. And even a couple of consumer names like Nike and Tesla had great days, mostly because expectations were so low that their news came as a pleasant surprise.
But while all this celebration was happening on Wall Street, some very serious economists were sounding the alarm. Mark Zandi over at Moody's put it very bluntly. He warned that this shutdown could be the very thing that actually triggers a full-blown recession. It just shows you the huge disconnect between the market's party and the economy's problems.
Okay, so we get the what and the why of what happened. But the real question for all of us is, okay, so what now? So let's shift gears and look at the playbook. 3 potential strategies you could think about in a market this strange.
We've broken it down into 3 different scenarios, really based on how much risk you're comfortable with. There's a high-risk growth bet, a medium-risk turnaround idea, and a low-risk defensive move.
All right, first up, the high-risk play, the AI growth bet. The idea here is pretty simple. Just lean into the hottest trend in the market. The thinking is that AI is a long-term revolution, and the idea of cheaper money from the Fed just pours gasoline on that fire. A simple way to play this might be a semiconductor ETF. Now, the risk, of course, is that if the Fed doesn't actually cut rates, these high-flying stocks could be the first ones to get hit hard.
Now, for a more medium-risk idea, you could look at the healthcare turnaround. This sector was the star of the show, and for a very specific reason: chatter about a potential deal on drug pricing. That would remove a huge political headache that's been hanging over these stocks. A name like Eli Lilly, for example, becomes a direct play on that specific news, which is kind of separate from all the Fed speculation.
And finally, for the more cautious investor, there's the shutdown hedge. This strategy is basically a bet against all that market optimism. It's a bet on economic reality catching up. If the shutdown drags on and recession fears really start to bite, investors tend to run for safety. A classic move here would be to look at an asset like gold, maybe through an ETF.
So that brings us to the final word on all this.
When you really boil it down, this entire crazy day was a tug-of-war between market optimism and economic reality.
It really comes down to two totally different stories. The bulls, who take the most positive view, say the market is being smart and forward-looking. It's ignoring the temporary political drama and focusing on the big stuff, long-term AI growth and a supportive Fed. But then you have the bears, the negative interpretation, who are basically saying the market is living in a fantasy world, completely disconnected from the real economic danger of a shutdown and just chasing a speculative bubble.
So, what's the big takeaway from all this? Well, it really comes down to two key risks you have to watch now. First, the shutdown itself. The market is betting this will be over quickly. If that bet is wrong, look out below. And second, the AI trade. The hype is massive, and valuations are stretched, making these stocks really vulnerable. And that leaves us with the million-dollar question. Will the market's powerful optimism keep winning out? Or is economic reality about to get the last word?